Hi, I'm William Mills. I'm here at Finovate Spring in San Francisco, and I'm pleased to be joined by Nasreen Quibria, who's Managing Director and founder of Q Insights. How are you doing today, Nasreen?
Wonderful, thank you.
So tell us about Q Insights. What do you guys do? How was it formed? What's your story?
It's an independent payments and research consulting company, and more recently, we've been focused on the crypto space, particularly the challenges around the on and off ramp between fiat and cryptocurrency. So it's an exciting time to be in this area.
Well, I've heard that there's an old proverb, may you live in interesting times. I think we are doing that right now. But I understand later you're going to be on a panel discussion about how attitudes about crypto are changing and how financial industry players can take advantage of these changes. Can you kind of give us a taste of what you'll be speaking about at the panel later today?
Certainly. So it is such an exciting time, as I mentioned, very volatile, and the tenor and discourse, however, has shifted dramatically from just 2 years ago. So despite all of the volatility and tumultuousness that we are observing today, the while cryptocurrencies were generally in the fringes before, but now they're more in the mainstream. And
Right.
you have individuals who are either trading, investing, and some are even using cryptocurrencies. And this has been made possible because you have the prevalent apps like Cash App and PayPal, where people can engage with digital assets, and it's made it more accessible to the general public. At the same time, you have institutional players embracing cryptocurrencies. So
Right.
Tesla and MicroStrategies, they are holding Bitcoin as part of their investment portfolio. You've got large companies like Fidelity and Goldman Sachs who are offering various products and services around this. However, what's also done is that it's attracted a lot of attention, and there's scrutiny from regulatory agencies because of the explosion of activity in this space. And unfortunately, the response has been disparate, it's ad hoc. And a few months ago, the president had an executive order that called for a coordinated and coherent approach to digital assets arena.
Right.
And so we're now at an inflection point where this nascent industry, depending on the regulations and policy that follow, it's going to be influenced very much by that. And so it's critical that we not only have responsible innovation, but have responsible regulation.
Well, that brings to mind that, crypto seems to me the only kind of currency that came from the ground up and not through the traditional financial systems, right? So how are financial institutions adopting and embracing this new currency?
Well, because there's not a lot of regulatory clarity around this space, and that's what both those in the crypto asset realm, as well as those in the traditional financial services side, are clamoring for more framework and oversight around this arena, because then there would be more comfort in moving in this direction. So one of the areas where there's promise is around stablecoins. And I'm sure you've probably heard a lot about this,
Right.
especially.
I wanted to ask you though, what is a stable coin and what makes it different from other crypto?
Sure. So stablecoins were developed in order to address the volatility issues of traditional cryptocurrencies like Bitcoin and, say, Ethereum, among others.
Right.
And not all stablecoins are created equal. You've got those that are asset-backed, so
Right.
they're pegged to a fiat currency like the US dollar, or a commodity, or a basket of cryptocurrencies. Or you could have an algorithmically backed stablecoin, such as Terra, that we've been hearing most recently about,
Right.
and have observed its death spiral. Now, this form of stablecoins, while there are risks associated with it because it's highly concentrated, and what you might have if there's significant flight of capital from the traditional financial services sector, then there could be systemic risk among other issues and potential bank-like runs, as we saw most recently. And unfortunately, consumers, without guardrails in place, they lost all of their savings. However, if there was more regulatory clarity, then traditional financial services firms could also play in this arena. And with framework in place, such as FDIC insurance-like guardrails, then there would also be protection for consumers. So while, as I mentioned before, there are risks, there are concerns, but there's also opportunities. So for example, with stable coins, it's decentralized. There are no intermediaries, and therefore where there's friction and pain points in our financial service sector, particularly with international money movement. So for example, if I want to send remittances overseas, it's opaque, it's time consuming, it takes a long time. But on the other hand, with the stablecoin, because it's decentralized, it's faster, it's more efficient, it's more economical, and financial services could be participating in this area. So when we talk about regulatory oversight and where there can be more comfort level from the traditional financial services, along with the fintechs playing in this space, then as long as there's more protection for consumers, we can also encourage innovation among all the players in this arena.
Well, I think that really addresses the risks and opportunities. I really wanted to ask you about central bank digital currencies. Like, should the Federal Reserve do that? And if so, is there a need for it? And when might this happen?
Excellent question, and very timely, because there is a discussion paper out from the Federal Reserve Board, and the comment period ends tomorrow. So because of all of this acceleration of unregulated digital currencies that we're seeing being adopted in the market, as a result, it's also brought spotlight into what you just mentioned is a central bank digital currency, or CBDC for short. And a CBDC would be backed by the Central Monetary Authority, or the Federal Reserve Bank. It's regulated and it would be stable. And in an economy such as ours, where it's a modern infrastructure, we already have many payment instruments and rails in place that's efficient, that's reasonably cost effective and fast in the domestic space. And so there isn't necessarily a compelling reason to move forward with a CBDC. However, there might be issues that could elevate the need for a CBDC in the future. For example, geopolitical considerations. So around 100 countries around the world are exploring CBDCs, and jurisdictions like China has been trialing a digital yuan. Now, they're known for their lack of privacy, and if that became prevalent, and while they've stated that they're focusing more on the domestic realm, however, we are aware that they're also trialing cross-border. So along with those concerns, and at the same time, if we look at what's happening with the US dollar as a reserve currency, there's research out there from IMF from last year that illustrates the decline of the US dollar. It's the lowest level in 25 years. So with risks like that, as well as concerns of countries such as Russia that would like to evade sanctions. So when you take all of these issues into account, then it's vital that we preserve the US dollar as a global reserve currency, and for national security reasons. There's one other issue that I want to also raise, and that's very near and dear to my heart, and that's related to financial inclusion. During the CARES Act, unfortunately, the very demographic, the unbanked and underbanked, that needed the stimulus payments the most, it took weeks, sometimes months, to reach them. And while a CBDC may not be a panacea for financial inclusion, however, it could enhance and enable access to the economically vulnerable and act as a tool for that. So in all, what I really want to say is that we need to continue experimenting, doing research.
Right.
The Federal Reserve Bank of Boston has been looking at this and working in this space in collaboration with MIT. And if we continue, we should continue to actually encourage work in this area so that when there is a time and the need for a CBDC, we're going to be prepared.
That makes sense. Well, last question. With your experience, and I know you work a lot in the crypto space, but what trends do you see having the biggest impact in related to fintech and financial services over the next 5 years or so?
So, as you've been observing, particularly at this event, that we are seeing unprecedented changes in technological innovations, right? And particularly in the emerging technologies realm, and that's going to shape what happens in the fintech and financial services sector. One, I believe, trend is around open banking. So where as more banks and credit unions are enabled with secure APIs, they'll be able to collaborate with fintechs and working together and opening up opportunities and connecting to platforms like digital apps and extending that to embedded finance, so that where you might have a traditional, say, financial product that is then incorporated into a non-financial experience, like walking into a Home Depot, or if you are purchasing a car or something.
Sure.
Another trend is real-time payments. So even before the pandemic, we saw an accelerated demand for expedited payments with emails, app alerts, text messages, all these connected devices. There's an expectation for immediacy. And it was just a few years ago that the new payment rail was stood up by the clearinghouse, the real-time payment solution, but it took 40 years to get there.
Right.
In 2 years, the Federal Reserve is going to be introducing, actually it's not 2 years, in 2023, I apologize, for the FedNow product. And the combination of those is going to expand opportunities for the fintech and the financial services space. And I want to add one more.
Sure.
And that's longer term. I do believe that the cryptocurrencies is going to have a pretty significant impact in this space. While today they might not act as a payment vehicle, but in the future, it will be a medium of exchange, a unit of account, and a store of value. And so when you consider the underpinning technologies such as blockchain and couple that with artificial intelligence and machine learning, and as we move to Web 3.0 and the next generation of the internet, then that's going to extend the possibilities and the way we do lending and deposits and payments. That's going to be different from what we have today, and the possibilities are endless. It's very reminiscent of the early days of the internet.
Yeah, I remember those days well. Well, Nasreen, I really appreciate you taking the time to sit down with me today. And again, this is William Mills at Finovate Spring.